last hour, the value of the cryptocurrency has hit an all-time high.
Bitcoin at fresh all-time highs.
Bitcoin
Cryptocurrency hitting a stock market.
The world watched history being made when Bitcoin hit an all-time high of $126,272. But today, the tables have turned, and in just a few weeks, 1.2 trillion erased from the total value of all cryptocurrencies. A rally that looked unstoppable suddenly collapsed. Just 8 weeks ago, Bitcoin was riding high. Euphoria was everywhere. But today, the crypto landscape looks vastly different. Bitcoin has plunged over 30%, wiping out every single gain it made this year and sending the entire market into deeper bear territory. And this isn't a simple correction. This is a perfect storm of macro tightening, market fragility, and technical breakdowns. If you're holding crypto or thinking about buying the dip, you need to understand exactly why this crash is happening. Today, we're going beyond the headlines to break down the technical and fundamental forces behind this massive sell-off. And more importantly, what you as a trader or investor should do next. Before that, if you want to catch the next major shift as it unfolds, not hours later when the opportunity is gone, join our live stream every day to stay updated on market trends and showing the exact thought process behind every decision. Do not forget to like, share, and subscribe. Let's deep dive into the reasons for the Bitcoin crash. The rapid plunge of Bitcoin is not due to one single factor, but a convergence of 5 powerful negative forces: unfavorable macroeconomic shifts, market deleveraging, technical breakdown, institutional distribution, and psychological shifts. Macroeconomic headwinds and the liquidity drain. The biggest trigger has been a dramatic shift in monetary policy expectations. Number one, the Fed's hawkish turn. The Federal Reserve and other major central banks have pushed back aggressive rate cut expectations into 2026. Boston Fed President Susan Collins signaled a mildly restrictive or somewhat restrictive policy, emphasizing that there was no rush to lower rates. And as a result, the market expectation for a December rate cut had plummeted from 98% down to just 40% in mid-November. Traditionally, Bitcoin attracts speculative investment when interest rates are low. The Fed's cautious stance drains liquidity from risk assets, making the zero-yielding Bitcoin less attractive compared to rising real yields on U.S. Treasuries. Number two, the global liquidity crisis involving the yen carry trade. Now, this second critical macro factor is the expectation that global liquidity will come down. This is tied closely to the unwinding of the Japan yen carry trade. Now, for nearly 2 decades, Japan acted as the world's interest-free lender. With Japanese interest rates stuck at or below zero, global investors, especially hedge funds, borrowed the yen at almost no cost and converted it into dollars to buy higher-yielding assets abroad. This was one of the simplest arbitrage trades in global finance. Borrow at 0%, invest in assets earning 4 to 8%, and pocket the spread. Trillions of dollars flowed into U.S. Treasury bonds, emerging market debt, tech stocks like Nvidia, and even cryptocurrencies like Bitcoin, all fueled by this cheap Japanese liquidity. But now, the Bank of Japan has flipped the script. After years of ultra-loose policy, Japan has begun raising rates towards 2 to 3%. Suddenly, the trade no longer makes sense. Once currency conversion and hedging costs are added, the yield advantage disappears entirely. So investors are unwinding these massive positions, selling dollar-denominated assets and repatriating capital back to Japan. This forced selling drains global liquidity, pulling money out of financial markets worldwide. With less liquidity sloshing through the system, all risk assets, especially Bitcoin, face strong downward pressure. Number 3, external shocks and perception of fragility. Now, political events such as the October government shutdown showed that external shocks can easily outweigh positive crypto sentiment, triggering steep drops. Furthermore, the Fed's announcement to end quantitative tightening in December, while technically aimed at preempting a recession, is perceived by investors as a sign that something somewhere in the financial system is fragile. This risk-off mode sends investors fleeing from speculative assets like Bitcoin and AI stocks. Market mechanics or deleveraging and outflows. Now, the scale of the price drop was amplified by leverage and institutional movements. Number one, liquidation cascades or the deleveraging phase means the market is undergoing a major deleveraging phase. Massive sell-offs triggered a liquidation cascade. One estimate cited 19 billion in crypto liquidated on a single day in early October. When the price drops sharply and traders cannot meet margin requirements, their positions are automatically liquidated, creating forced selling that accelerates the crash. Number two, spot Bitcoin ETF outflows. A crucial structural weakness emerged as spot Bitcoin ETF inflows, which fueled the earlier rally, now reversed dramatically. US Bitcoin ETFs experienced substantial net outflows totaling 3.79 billion in November. When redemption requests are filed, ETF providers must sell their underlying Bitcoin holders to return cash, effectively dumping supply onto a stressed market. Number three, strategic profit taking or the IPO moment. Data shows that large holders or whales have been methodically taking profits, moving billions in Bitcoin to exchanges since late October. This phenomenon is described by some as Bitcoin's IPO moment. Thanks to the institutional liquidity provided by ETFs, early investors can strategically cash out billions without crashing the market instantly, resulting in a gradual transfer of wealth to newer institutional buyers. Number four, short-term holder capitulation. Selling pressure intensified as short-term holders who bought in the preceding 3 months increased selling pressure, realizing massive losses once Bitcoin breached the psychological $100,000 mark. Technical breakdown and correlation. The fundamental fear was confirmed and exacerbated by technical signals. One, high beta risk asset correlation. Bitcoin is increasingly trading like a high beta tech stock, meaning an asset that moves more sharply than the overall market and surging higher in risk on rallies and plunging harder when sentiment returns. That's exactly why unease over a potential AI bubble and the sharp sell-off in soaring AI and tech names spilled directly into crypto. As investors pulled back from speculative, growth-heavy assets, Bitcoin was hit almost instantly. In today's market, its behavior mirrors high volatility tech, which is why analysts often say when tech sneezes, it's natural to expect Bitcoin to catch a cold. Number two, technical damage confirmed. Technical indicators signal the end of the bull run. The death cross, technical damage is intensifying, highlighted by a classic death cross and a fall in price below the 50-week moving average. The death cross is a moment when the 50-day moving average drops below the 200-day moving average, signaling a shift from short-term strength to long-term weakness. The crossover is one of the market's most widely recognized bearish indicators, often suggesting deeper downside ahead. Support breakdown. The price dropped below key support levels, including the 92,000 to 93,000 range, triggering further margin calls. Technical analysis suggests a weekly close below the long-term uptrend line at 85,628 would indicate a confirmed break in the trend. Institutional distribution. Smart money is quietly exiting. Adding to the pressure is clear evidence of institutional distribution. Large investors and funds have been selling into strength as liquidity thins, leading to rising exchange inflows and repeated failures at key resistance levels. This behavior suggests that the smart money is shifting from accumulation to exit mode. When institutions distribute while technicals are breaking down, it often accelerates and deepens market corrections. Internal frictions and psychological shifts. Lastly, subtle market frictions added to the volatility. Lack of retail fuel, retail enthusiasm is conspicuously absent. Google search volume for Bitcoin has fallen 65% from its May peak. Without fresh capital from smaller investors chasing FOMO, or the fear of missing out, the market lacks the necessary fuel to counter institutional profit taking. So what can crypto traders do? This market volatility is challenging, but bear markets are where fortunes are both lost and made. For those navigating this crash, discipline and capital preservation are key. Number 1, avoid emotional reactions. Do not panic sell at the lows or engage in revenge trading with leverage. Remember that large declines are not unusual for Bitcoin, which is still a volatile, less mature asset compared to gold. Number 2, focus on accumulation and quality. Given that this current drop, down 31% so far, looks more like a painful correction in an ongoing bull cycle, similar to mid-2021, focus on dollar cost averaging Bitcoin and ETH over weeks or months. Number 3, manage risk and liquidity. Never leverage your trades, implement strict position sizing and stop losses. Crucially, keep substantial flat emergency fund or dry powder, ideally keeping 50% or more cash ready for deeper dips. Number 4, reassess your horizon. Buying the dip only makes sense if you have a long horizon of 3 to 5 or more years. The recovery will depend heavily on the Fed's December decision and regulatory clarity. So to conclude, Bitcoin's sharp downturn isn't the end of the story, it's a reset. The market is finally acting like a mature asset class, reacting to real macro pressures and institutional flows. In the short term, that means more volatility, but the long-term foundation remains intact. Institutions are still accumulating, corporate adoption is rising, and Bitcoin's structural demand hasn't changed. This sell-off is shaking out leverage and weak hands, just as it has in every major cycle. Stay disciplined, stay liquid, and stay long-term focused, because in crypto, the next big move often begins exactly when the crowd believes that the story is over. If you found this breakdown valuable, smash the like button and subscribe for more real-time market insights. Let us know in the comments below. Are you buying this dip or sitting on the sidelines?